Welcome back, traders. In this video, we are diving into two very important concepts in smart money trading. All right, and that is the ICT SIBI and BISI. Okay, now let us just start with the basics. SIBI stands for sell side imbalance, buy side inefficiency. Okay, I repeat, sell side imbalance, buy side inefficiency. That is what SIBI stands for. Then, as you would have already assumed, BISI stands for buy side imbalance, sell side inefficiency. I repeat, buy side imbalance, sell side inefficiency. Now, at first glance, these names might sound complex, but the concept is usually, very straightforward. It's actually straightforward. Both SIBI and BISI describe price imbalances that occur when the market moves aggressively in one direction, leaving behind inefficiencies on the chart. Okay? So why does this happen? When institutions push price strongly upward or downward, they sometimes move so quickly that not all orders get filled. Okay, so this creates areas where the market is unbalanced. These imbalances are important because the market often comes back to revisit those areas, filling the inefficiency before continuing in its intended direction. Okay, so now let us look at them one by one. A SIBI usually occurs when there is a sell side imbalance and a buy side inefficiency. In practice, this means that price moved quickly to the downside, leaving an imbalance on the chart. So you'll often see this as a strong bearish displacement candle, okay, or a series of candles dropping sharply, like what we can see happen here between these two candles. So these zones often act as reference points where price may return later. And as you can see in this example, you can see that price actually returned to this imbalance zone. See, between these two candles, you can see how price actually came back to this zone before continuing in its original direction. Okay. So on the other hand, sorry. Now we'll talk about BISI. BISI occurs when there is a buy side imbalance and a sell side inefficiency. Okay, in this case, price moved quickly to the upside, right? In this example, we can see that. So price moved quickly to the upside. You can see this particular candle, leaving an inefficiency behind. On the chart, this shows up as a strong bullish displacement candle, often after liquidity is taken. Just like with the SIBI, this zone tends to attract price back, right? So you can see price is usually attracted back before the next move unfolds. Now, how do you use SIBI and BISI in your trading? The first step is to identify them clearly on your charts. Okay, just look for large impulsive moves that leave behind gaps or inefficiencies in price action. Okay, then you mark those zones because they often serve as magnets for price in the future, right? The second step is to combine SIBI and BISI with market structure. For example, if the market is bullish, okay, you'll be more interested in spotting BISI zones. as continuation areas. All right. If the market is bearish, SIBI zones become more relevant. Okay. By aligning imbalances with the bigger picture, you'll be able to filter out noise and focus only on the most meaningful setups. All right. So here's a simple breakdown of how to apply this. You need to start by analyzing the overall trend with market structure. Okay. Identify areas on the chart where strong displacement candles created inefficiencies. Then you mark those SIBI and BISI zones as reference points. You watch how price reacts when it returns to these zones during future sessions. So what you will notice over time is that price often respects these imbalances. They reveal where smart money had to move fast, and they provide you with valuable insights into potential future price behavior. Okay, so to put it simply, ICT, SIBI, and BISI are the footprints of institutional trading. So once you train your eye to spot them and to spot them properly, the charts will start to make more sense to you. Okay, and you'll have a clear framework to understand why price is drawn to certain levels. Okay, you can even see this other example. You can see this other example, how we had this sharp price moves and we had this inefficiency around here, right? You can see that price actually came back, tested the zone, and then dropped further before the zone was eventually broken. All right, but the main thing is that as price came back to test the zone, it's actually, still went down before the bullish breakout occurred. All right, so that is the full breakdown of ICT, SIBI, and BISI explained. If this video gave you more clarity of how price imbalances work, make sure to click the like button and hit subscribe so you never miss upcoming lessons on ICT strategies, smart money concepts, and Forex education. Thank you for watching, and I'll see you in the next video.